bringing this up only because I think it's a subject that, for one, I think it gets a little bit of a bad rap. And number two, I think it still has a lot of confusion around it. And that's the whole concept of PMI. And of course, somewhat humorously, I try to suggest that here with my title, is PMI the devil? And the reason I say that is in talking to borrowers, prospective borrowers, I've noticed throughout all my years of doing this, PMI is just deemed to be a really bad thing, a really negative thing, and most borrowers try to avoid it. It's almost in the same basket as folks who are afraid of a mortgage hard pull on their, for their credit report is going to create this inquiry that's going to crater their credit scores, which I discussed recently. That doesn't happen. That's an undue fear that most consumers have. And I think PMI is somewhat in the same basket. PMI is actually a good thing, and it provides a lot of benefits to borrowers. So I want to kind of break through that belief that PMI is such a terrible thing that you should always try to avoid. So first of all, what in the heck is mortgage insurance all about? Well, it's not the same as the insurance you get on your house. Mortgage insurance lowers the risk to lenders who accept lower down payments from borrowers. Now, why is that? Because most borrowers will say, well, wait a minute, I'm going to pay for an insurance policy essentially that's going to benefit the lender and not me. Well, of course, they're not realizing there is a benefit to them as a borrower. But yes, there is a benefit to the lender. Prior to, in the early days of mortgages going back during the Great Depression, a mortgage typically required a 20% down payment or more in a very short loan term. Well, the Roosevelt administration came up with the idea of getting the FHA to offer financing at much more extended repayment terms, up to 30 years, with a much lower down payment. Now, in order to induce lenders to do that, they had to create the concept of mortgage insurance. So that mortgage insurance actually insures the lender in case the borrower defaults because they are putting very little money into the purchase of the home or into the loan. So that's really how the whole concept of mortgage insurance came up. It was actually FHA mortgage insurance was the initial product, again, used to insure a lender and in case the borrower defaults. So the idea was, because FHA allowed a 3.5% down payment, which was unheard of in the lending community back in those days, the lenders were induced to make that loan under the promise that if they have a borrower who defaulted because of a low down payment, couldn't handle monthly payments, they could then submit a claim to FHA, actually to HUD, Department of Housing and Urban Development, and get reimbursed for the foreclosure loss. So that's what triggered more lending and spurred more home building and spurred more home buying. Now, what is PMI as it relates to that? Well, PMI is an acronym for private mortgage insurance. So that's the important thing to distinguish. PMI is not the same as the mortgage insurance on an FHA loan. Two different things. Why is it called PMI? Because PMI is used to insure loans that are not guaranteed or insured by the federal government. So conventional conforming loans, yes, loans sold to Fannie Mae and Freddie Mac, even though those are quasi-governmental agencies, those loans are not insured or guaranteed by the federal government. Those are actually private companies. And so mortgage insurance used for non-FHA mortgages, conventional conforming mortgages, became known as private mortgage insurance. So that's the distinction. PMI is private, used on conventional loans. The FHA mortgage insurance is only on FHA loans. Now, the amount of, one of the big concerns about the PMI is the cost, that it's going to be unduly costly to the borrower. And in addition, what does PMI actually do in terms of insuring the lender? Well, the PMI coverage is going to insure the lender by as much as 35% of the loan amount down to as little as 6% of the loan amount, depending on credit score and the loan to value. And then in terms of the premiums, there are two different types of premiums associated with PMI. One is LPMI, or lender paid mortgage insurance. With this, there's a single lump sum financed into the rate, and the premiums can range from 0.61 to as much as, believe it or not, 10%, depending on the loan to value and credit score. The other type of PMI is BPMI, or borrower paid mortgage insurance. With this insurance, the borrower pays a separate premium, an annual premium. They pay it monthly as part of their mortgage payment. Now, the base premiums on this range from as little as 0.17 of the loan amount to as high as 1.86 of the loan amount. And then there's additional premium adjustments for various risk factors. So I'm going to have Jeff pull up a rate card for PMI so you can get a better idea. Now, this is very small. You aren't really able to read this, but the column on the left, that is a column that shows the range of premiums that will be charged depending on down payment as little as 3%, down payment increased increased to 85%, 15% down, 85% loan to value. And you can get a kind of an idea as how the premiums change. For example, if you're putting 3% down and your credit score is between 620 and 639, the premium for the PMI is quite high, 1.86%. But if you're a very high credit score borrower, over 780, and you're putting 3% down, then the PMI premium only drops to 0.58. And so the point of this chart is you can see that the premiums will range depending on a various number of factors: credit score, down payment, and then also down at the bottom, there's additional adjustments for second homes, employee relocation homes, loans, manufactured homes, etc. So understand that, that what goes into setting the premium for a PMI coverage is relatively complex. Now, one of the things that has always been the case when it comes to PMI, I've seen it for years, is because it's deemed to be so awful and that you should try to avoid it at any cost, there's been a strategy that's been used in the industry for years to try to avoid PMI even when you're putting a minimum down. And that concept involves something what we call a piggyback loan. Now, what is a piggyback loan? Well, I call it a PMI avoidance scheme, and that to some degree is true. Otherwise, I wouldn't call it that. But the basic idea with a piggyback is to avoid PMI, you split up your financing. Let's say, for example, you only have 10% down, but you don't want PMI. You want to avoid that. Well, what you would do is set up you'll get a first mortgage at 80% of the price of the home. You'll then get a second mortgage, usually a HELOC, for 10% of the price of the home. And then you put 10% down. This is called an 80-10-10. And with that structure, there is no PMI. Why? Even though you're only putting 10% down? Well, the reason is because the lender holding the first at 80%, that doesn't require PMI, because PMI, by the way, is only triggered when the loan to value is above 80%. So with the 80-10-10 piggyback structure, because the first mortgage is only 80% of the value of the home or the price, there's no PMI triggered or required. Now, a second mortgage generally will have a higher rate than a first mortgage anyway. Those, as a rule, don't ever have PMI on them, have any kind of mortgage insurance on them. And so as a consequence, that second mortgage piece, usually a HELOC that's at 10% of the price of the home, that doesn't have PMI either. So this is a way you can avoid the cost of PMI by simply splitting up your total financing into two different loans, a first and a second. We can do 80-15-5s, we can do 80-10-10s, we can even do 85-15-5s. So there's a lot of different ways to structure this. Now, this is usually done because it's perceived to be the case that by doing a piggyback, you're going to end up with a lower housing expense than if you take the single bigger loan with a PMI premium added to it. So let me give you an example to show you how that's not really the case anymore, at least not right now. So consider a home purchase for $600,000 at 90% loan to value and a credit score of 760. Now, if we use a HELOC as part of a piggyback, we're going to have an 80-10-10. Again, 80-10-10, 10% down, 10% second, 80% first. Well, that 80% first and 10% second, that also equals 90% combined loan to value. Now, when you do it this way, and I did this yesterday using current market rates, the monthly housing expense for a piggyback loan, counting both the first mortgage and the HELOC, would be $3,996. And this, by the way, assumes that the payment on the HELOC is only required to be interest only. So that means that 10% HELOC portion, the minimum payment you're making doesn't even pay down the principal. It's simply paying the interest. But even with that, plus the principal and interest payment on the first, the total housing expense, $39.96, excluding taxes and homeowners insurance. Now, compare that to the other alternative. Get a 90% loan, no second mortgage. You're not doing an 80-10-10. You're going to get a first mortgage at 90% of $600,000 with borrower paid mortgage insurance. Now, when you take that approach, the monthly housing expense is $37.58. And that includes, by the way, the PMI premium under this scenario at $99. And by the way, I'm using the best credit score possible, 760 plus. So as a consequence, what this shows is that the housing expense is actually lower by $238 by getting a single loan at 90% with the borrower paid mortgage insurance, rather than trying to avoid that PMI by going the route of an 80-10-10. So as a consequence, what I want you to realize, this is a good example of why PMI is not something to avoid. It's not something that just costs too much and doesn't provide you a benefit. In fact, it does the opposite. It allows you to put less money down. And in most cases, if you have a decent or good credit score, the amount of the premium is going to be reasonable as it relates to what the housing expense would cost if you went the other route and did a piggyback. And then my most favorite part of the PMI option is understanding that PMI, specifically borrower paid MI, not lender paid MI, but borrower paid MI, is cancelable in the future. Now, we're going to cover that in an upcoming show where I'm going to get into details about how you can cancel your PMI. But just understand that that is a sort of a subtle benefit of PMI, and you should always keep that in mind if you're faced with how to finance a purchase where you're putting less than 20% down and deciding whether to get a single loan with PMI or go the piggyback route. So hopefully that helps and clears up some of the confusion as it relates to PMI. Trust me, folks, it's a good thing, not a bad thing. I would encourage you to not avoid PMI, because in the long run, I think it's going to be better off for you. Thanks, everybody, for watching. And just remember, at MortgageWorks, we have the answers, and they're on the house.